Hello, everyone. We are just to begin the webinar today. My name is Brian Owino. I work at Microsave Consulting as a senior analyst in the practice group of climate change and sustainability. Within the department, within the practice group, we focus on key issues around climate adaptation, climate finance, and the issues of locally led climate adaptation. And today's session marks our 8th CRAG VC, which is focusing on building resilient agriculture within Africa and within the other continents and beyond to empower smallholders as well as building ecosystems that can promote sustainability. Just briefly to introduce Microsave Consulting, we are a global consulting firm that has been operational for over 25 years, working to bring financial inclusion in the underserved markets. This is in line with deployment of digital financial services, as well as supporting different banking and financial institutions to ensure that financial products reach those that deserve it the most. In this session today, we'll be speaking about mechanisms and understanding the topic, delving into de-risking green commercial finance, which is really critical, especially in the scope of sustainable development goals. And as we aim towards achieving sustainable development, the SDGs towards 2030, a very short timeline is remaining towards that. And we believe that tackling climate change, as well as addressing the gaps of financing, will be filled in by green finance. Just before I introduce the speakers or the panelists today, I will invite my colleague Pranav to give us a brief intro and a bit of context of green finance as an emerging issue. To you, Pranav, for a brief introduction on this.
Thank you, Brian. Good afternoon, everyone, and I welcome you to this last chapter of our CRAG VC for this year. As I introduce myself, I'll also pull up a PPT that we will quickly take through to sort of get familiar with some of the terms and the focus areas for this discussion and set the basis for discussions with our panelists who have been kind enough to share the time with us. My name is Pranav. I lead the climate practice in the East and Southern Africa. I'm based out of Nairobi. And as part of MSc in our climate practice, we focus on enabling locally led adaptation, particularly towards how can financing be enabled all the way to the local levels with empowered communities so that they can understand their own requirements and needs and work towards building that resilience. Today, we are focusing on the green commercial finance and how can we de-risk it to enable a larger flow towards smallholder farmers and MSMEs in Africa, which, as we'll soon talk, is a very important need. I hope my slides are visible.
Yes, you are.
Great, thanks. So let's start with setting the context. The green commercial finance, basically, when we talk about this, we are looking at financial instruments that are designed to promote investments into projects or activities that have a positive environmental impact. In the context of Africa, as in the case of other developing countries across the world, smallholder farmers and micro and small enterprises tend to benefit or could potentially benefit the greatest from these. This is because being at the grassroots, they are responsible and they have an urgent need to transition to the green technologies to reduce the overall impact and to set themselves on the pathway of resilience, while doing so, ensure that they are persisting in the economic growth, so that this sort of transition is not coming at the cost of short-term economic impacts. We have looked at some of the data available on the climate finance reports in the continent. as per IFC, and this is IFC's own contribution to Africa, around $11.5 billion have been sort of invested in Africa towards climate finance. It does seem like a large enough number, but when you think about the overall requirement of $2.8 trillion that are required by 2030 to simply implement the NDCs, the nationally determined contributions of the various countries under the Paris Agreement, we are nowhere close to that target. In terms of the agriculture sector alone, the market potential is estimated to be around $1 trillion, and this allows opportunities for digital technology to enhance the productivity. So we mustn't look at investments in climate finance as simply a resilience strategy, although that is the case and it is important. It also allows farmers to improve their production, and long-term productivity is supposed to benefit the world as a whole in food security and other macro economic indicators. We find that only 10% of the green finance flows to the SMEs and to the smallholders. So even from the small amount of climate finance which is currently reaching the continent, only 10% of it actually flows all the way to the SMEs and the smallholders. That said, we do have some initiatives such as the Development Bank of Southern Africa's Climate Finance Facility, as well as Rwanda's FONERWA, which focus on de-risking green projects. And we are going to talk about the importance of de-risking and the necessity of crowding in private sector investment. Now, what does green commercial finance include? It comprises multiple financial tools and instruments. I'm not going to cover each of those, but broadly we can look at it as either equity or bonds, depending on the nature of investment. These could be investments that are either debt that are raised for investing in renewable energy and energy efficient projects, or these could be private sector or venture capital investments into renewable energy solutions. Very interesting. The other two interesting aspects I think I would like to focus on are the catalytic first loss capital or credit guarantees, as well as carbon credits. We are quite familiar, I'm assuming, with carbon credits. The idea, I think, has a lot of potential in it. We do see some challenges in implementation, which could be attributable to teething troubles. With carbon credits, I think there is a lot of tests and investments that are happening, but there seems to be some intent and policies coming into place finally that are looking to ensure that there's high integrity in the market itself, and that the credits that are being offered are of high quality and are in fact a representation of reduction in greenhouse gases that they represent. So I do see there's still a long way to go around here, but this is quite promising as an intervention. Catalytic first loss capital, I think, is very crucial because public sector finance itself will not be sufficient to meet the huge requirement for investments in climate resilience and climate financing. And as such, it does require us to look at private sector capital flowing in. However, as we do understand, private sector, for understandable reasons, could be risk averse, and there's therefore a need to de-risk this mechanism. Catalytic first loss capitals and credit guarantees all the way across from tier 1 through tier 3, tier 4 institutions can play that role of leveraging additional capital, so sort of multiplying the effect of a limited amount of the public sector capital to crowd in the additional private sector capital, and therefore being able to meet or at least come close to the ambitious requirements of climate financing. We do see a lot of international development organizations playing a part in this. The public sector governments will eventually need to step up, but given the context of the developing countries that are most vulnerable to the effects of climate, and we do see an important role for developed countries to play a part in enabling these sort of de-risking mechanisms. Now let's talk about some of the structural challenges that have so far limited the access of green commercial finance among smallholders and the agriculture small enterprises, small micro enterprises. First, I think it is the nature of the sectors themselves. Agriculture tends to be risky, even without climate and the risks it poses. But now, increasingly with the climate effects, the risks have been exacerbated. Combining that with the nature of the income and the smallholder farmers, where they lack traditional collateral, they are unsurprisingly seen as a high risk. They're seen as a high risk segment, and therefore, without any external intervention or de-risking mechanism, the private sector will often be will be reluctant to forward the credits to the segment. The high operational costs in respect to the small transaction amounts is something that adds a lot of operational cost and makes it unfeasible for the private sector institutions to again function. And these are basically the business as usual scenarios, and we will talk about how some of the interventions can improve these. But as it stands, these are the binding factors. But the challenges are not just on the supply side. We also see demand side constraints around limited knowledge of such products or services, limited as they may be, amongst smallholder farmers and enterprises, or the fact that the processes can be very rigorous or the products not tailored enough for their needs, creating a demand side reluctance to sort of accept these or to seek these additional financing mechanisms. And as a cross-cutting mechanisms, we see that a limited financial infrastructure across most of these climate vulnerable countries further reduce the this demand and supply integration and therefore information sharing or awareness. As a result, this depresses the demand and makes it more expensive for the supply side to serve the households most vulnerable and most at risk. Based on these structural risks that we spoke about, there we can talk about risks that are perceived in three different segments. We spoke about the inherent risk within agriculture. So we understand production risks, and agriculture as an activity itself is fraught with a lot of uncertainty, which is further exacerbated by climate. Beyond that, we spoke about the credit risks, where the financial service providers in a purely private market do not are unable to serve the most the let's say the bottom of the pyramid where the need is most dire. However, there's when we speak about the demand side, there is a reluctance amongst these farmers and these enterprises to seek such financing, and for very valid reasons. Every increased investment also poses, as much as it offers opportunities, poses additional risks. There are challenges, the uncertainty of both agriculture, but also the markets in which these products are supposed to be sold. We can talk about the price fluctuations. And these price fluctuations go beyond local markets, and they can often be affected by some of the international and national economic conditions and trade. As a result of these price fluctuations, the farmers are unable to manage or anticipate a steady cash flow, which increases their risk and are therefore makes them reluctant to take on additional risk through additional credit. And in the absence of any social protection measures or any de-risking mechanisms or safety net, this diminishing of demand is expected to persist. What can we do? And we will speak more in depth with our panelists about this. But broadly, I want to touch upon a few points that we can sort of look at, and I would like to hear more about that in today's discussion on what can be done to catalyze the green commercial finance, given everything that we have discussed. So the growth itself in the demand can be met through two ways, through direct financial literacy and awareness programs, but also through gradual exposure and even basic financial inclusion measures, which can slowly uh, sort of expose the farmers and the enterprise owners to these opportunities and these services, can ultimately make them comfortable with leveraging green finance, which can be specialized for their transition needs. We do identify a very important role for government and international financial institutions to de-risk the sector. This would enable the private sector capital to flow in and sort of allow the scale to be achieved, which no single party can individually achieve by themselves. We have also seen a lot of advancement in the technological space, with fintechs both enabling access and outreach to the last mile, but also leveraging very innovative mechanisms for risk assessment through a lot of data crunching. And so now with increased capacities available to us through AI, we can anticipate that with available data, there can be there can be innovative mechanisms and very cost-effective mechanisms through which the financial service providers can both identify and categorize the right customers and also be able to reach out to them very effectively. This does require investment in data generation itself, which is again a role that we see for government and international development agencies. And finally, when we talk about leveraging green commercial finance and making it accessible, we should see this not as something that solely affects commercial, but also the other development goals. When we think about vulnerabilities, we identify that women-owned farmers, which might have traditionally been excluded from these services due to lack of collateral per se, can be specifically focused on, and there can be assessments that can be designed for them, so that while we are meeting our climate goals, we are also able to achieve simultaneously our other economic and development targets. So this is all from me. I hope this is a sort of a framing for what we would like to discuss and probe further in this discussion. And I'm looking forward to a very enriching conversation. Thank you so much all for your time. And thank you so much, Brian. Over to you.
And thank you. Thank you very much, Pranav, for giving that intro and setting the context very clear. It will be very exciting also to dive into some of these components with our panelists who are experts in this sector, but also working at the interface of finance and SMEs, also working as well with smallholders. So at this point, it's my pleasure to introduce the three panelists. Melanie, who is the CEO and the founder of Melanie Capital. Also Alpha, who is the Global Partnership Coordinator at CARE, and Leonard Kambona, who is the Country Coordinator at UNCDF. I'll just to introduce each of the panelists, we'll ask, as part of the introduction, you just mention where you work and how you currently interact with green finance, and some examples of initiatives that touch on climate or green finance for smallholders and agri-SMEs. We will start in the order of Melanie, Leonard, and then Alpha. Thank you.
Good afternoon, everyone, and thank you so much for having me. Thank you so much for this great presentation. It's fantastic to be discussing this with you. So my name is Melanie. I'm the co-founder and CEO of Melanie Capital Neobank. We are a carbon credit digital bank, so we're a fintech essentially that aims at supporting farmers in corporate value chains to go green and access carbon credits. We work notably with like coffee farmers and tea farmers in Kenya, helping them to access solar irrigation, plant additional trees, and then access the carbon credits. So in essence, we are an aggregator of like all those carbon savings, and we look at redistributing the carbon credits across the value chain. I'm happy to be here, and I look forward to the conversation. Thank you.
Yeah, thank you. Thank you very much. My name is Leonard Kambona, Country Coordinator, UNCDF, based in the Pacific. UNCDF, just to give you a snapshot of what we do and how we interact with the green economy. UNCDF is the UN's capital investment agency that is specifically mandated to ensure that we mobilize and catalyze capital, particularly for inclusive growth in the least developing countries. One of the key focus areas at UNCDF is to ensure that we enable, we mobilize and we catalyze the flow in the crowding in of capital into public and private finance areas for the least developing countries. Certain kinds of programs that I have engaged in the recent past is capacity building for government and government agencies, building of data and information for emerging areas such as blended finance, and catalyzing engagement of different stakeholders for policy development and advocacy. So we'll be speaking more about these aspects. Over to you, Brian.
Yeah, good afternoon, everyone. My name is Alfaxa Gitaondongo. I work for Kia Denmark, based in Nairobi, but supporting 8 countries that we work in. And my role on a normal day is to support with how do you mobilize financing to go to support smallholder farmers that are struggling with building resilience, but also struggling with the effects of climate change. And how this looks like is one, looking at the local available kind of resources within private investments, and how do we make them accessible to smallholder farmers and to MSMEs. So catalyzing that side of financing. But then also on the other hand is looking at, since my employer is based in Denmark, then trying to look at what are the available resources within Copenhagen and within the Danish market that could also be deployed to the African market, and how do we support these companies to be able to deploy that market? So trying to look at really how do you bridge that gap in terms of financing, but also how do you build capacity of farmers to be able to access some of this financing? So I'll be sharing some of our work in a number of countries that we've been able to work on to support farmers to be able to access financing and support them to be able to actually build their credit worthiness and access some of this finance. So thanks, and looking forward, Brian. Over to you. Thanks.
Thank you. Thank you very much. This is very exciting, particularly with all the 3 panelists, Alpha, Melanie, and Kamona. The work that you're doing is really instrumental to this discussion. And just to chip in with you, Alpha, based on your interaction with smallholder farmers, how do they perceive the types of risks that they face, as well as how do you see the traditional financial institutions? How are these risks different when it comes to green finance? What is the intersection? What is the interaction between the traditional financial products available for farmers and the emerging green financial products?
Yeah, thanks, Brian. I think it's interesting to be having this conversation at a time when COP29 has once again failed to deliver some of the most interesting kind of deliberations that we were looking at having them delivered. And this COP was actually termed as a climate finance COP, which ended up being a climate out finance COP, looking at what we need to actually address or to actually implement the NDCs that we have as countries, and mostly developing countries, but also looking at what is available at the moment. Yeah, so trying to look at that picture for now would be interesting, because then we go a step further and now start asking ourselves, so we have not been able to deliver that at this point in time, and then we are living at times when farmers have to grapple around with a lot of effects of climate change, which that means that and I think most of us have been brought up in a farming family, and we've seen how our parents, our fathers and mothers have struggled with actually producing even a single kind of bag of maize. Yeah. So on one hand, we have a sector that is grappling with a lot of risks, which banks and traditional banks would actually run away from. But also on the other hand, we're looking at a world where a lot of possibilities in terms of addressing those risks is possible. And this is where green finance comes in. Yeah. Because when you look at, for example, we have a farmer in Rwanda who has actually been able to do irrigation, but then not just irrigation, but go a step further and try to look at how do you install gadgets within that irrigation field enabled by AI and IoT that actually is able to give you all the data that you need within that farm. Yeah. What that means is that data supports you to actually get credit, because then it means that you are actually lowering the risks that are involved in that enterprise, and it actually gives you more stake in terms of this could actually be a farm that you can actually be able to access green finance from. Yeah. But secondly, is trying to look at some of these innovations are too costly, and farmers, if they are able to actually get them, would actually address some of these issues. But then how do we support farmers to actually be able to access some of these innovations that would actually lead them to actually accessing some of this green finance? Yeah. So I see a place where we need to really be very keen on how do we interact between the interaction between green finance and the traditional normal kind of financing is an enabling environment where fintech and AI and technology is coming in at a very serious play, and how we use that to actually address some of the risks that we would say would prevent farmers and MSMEs from actually accessing green finance. So I'll leave it at that for now, and yeah, I'll give more submissions later. Thanks, and over to you.
Thank you, Alvin. You mentioned a very interesting point, particularly on how can we support farmers access this financing. And earlier on, Leo, you were speaking about enabling, mobilizing, and catalyzing finance. So I see a connection on this, and risk is becoming one of the key challenges. But how then can we enable farmers? How can we make green financial products more accessible to farmers, more accessible to agri-SMEs, given their contribution in the economy of Africa? Maybe just to share your thoughts on that.
Thanks, Brian. So,
thank you.
Sorry. Should I go on?
Go ahead.
Okay. Maybe just to...
Leo. Yes, sure. Go ahead.
Right. So basically, I'll draw from some of the insights that we see and the lessons that we see that enable, scaling up of access and usage of the green finance products. And the one of the most impactful one we have seen is being able to ensure there's enabling policy and there is enabling regulation in scaling up access and usage. I'll use a specific example where we have mandated use, sovereign mandated use of particular products, green finance products. There's usually a quick uptake because of that mandate by the government. So ensuring that there is a very central involvement of government, particularly in ensuring enabling policy and regulation, is important. And a second example I'll give of that is where, for example, we have policy that is able to create a taxonomy, a green taxonomy of some of the SMEs that we have and of the smallholder farmers that we have in this space. Then this makes these players recognized and incentivize them from the demand side to participate in the green economy space. Secondly, there is one area that is lacking but emerging, which is building the body of evidence that is necessary to create confidence in the ecosystem. One specific example of that is building of demonstration effects. So ensuring that we have enough proof of concept of some of the emerging areas that can then be used to leverage and catalyze scale in those particular areas. And I would also be able to encourage the players and who are practitioners that are in this meeting today to put a more focus on ensuring that we have more demonstrated effects of some of these tools. One specific area that we need to strengthen and is for the private sector and also for the government is specifically being able to ensure that we are able to support with the technical assistance capacity building, particularly for structuring of areas such as blended finance. So I will stop it at that. But these particular three examples are some of the most impactful we have seen as we have engaged in the green economy space and ecosystem in the various countries and markets that we have in. Over to you, Brian.
Thank you, Leo. Policy is indeed a very critical element in supporting the capital markets and even framing how the finances flow. And you indicated very good examples of how this can be structured in order to support SMEs as well as the smallholder farmers in accessing this finance. However, one component that we are really trying to understand as well, and also was highly debated in the COP29, is the role of private sector And with us here, Melanie sits at the core of private sector, particularly engaging in mobilizing finance. Melanie, how can private sector take part? What is the role of private sector in particularly commercial banks or the equity providers or even other forms of financing? What is their role in de-risking green finance for smallholders, and what incentives could drive private sectors to even participate more in this noble mission?
Thanks very much, Brian, for this question. So essentially, the private sector has a huge role to play because when it comes to mobilizing capital, if you look for $1.3 trillion to be mobilizing in the next decades, you absolutely need the private sector because the public funds will not cover it. So we see a lot of banks across the continent that have received significant amount of debt financing from development finance institutions like KfW, the African Development Bank, the Agence Française de Développement, who actually already provided from 10 million all the way to $100 million of green financing to those banks. Now, the problem that we have to look into is how this debt financing can be deployed towards smallholder farmers, which is the backbone of the agricultural industry in our continent. Smallholder farmers, when you look at how they take up loans, they usually have very small amounts. They're not like borrowing $1 million or $5 million. If they're small, they're going to borrow anything between $10,000 to $100,000, which are very small tickets for the banks. A lot of them are not necessarily formal. So we see a lot of farmers that are like either sole proprietor or even just doing it on their own name. And then they don't necessarily have constant cash flows, which means that they're not necessarily able to pay back their loans every month. They need a grace period, or they need to have like an adapted, flexible cash flow loan. So those three aspects is what deter a lot the private sector from engaging, because banks are like for-profit businesses that necessarily need to be able to recover the loans plus interest, and this lack of cash flow visibility plus lack of compliance with what the bank's requirements are usually the reason why they're not engaging more in green financing. So there is a lot of mechanism that we have as a fintech tried to work on to be able to support those banks. The first one is digitization. So the idea of like helping banks to first get towards the farmer, because most of the banks don't actually have branches and relationship officers that go as far as that reach the farmer directly. So digitization was the first aspect, and kind of like dispersing digital loans or mobile loans that will have less requirements than the usual commercial banking that they're looking at. The second is partnership with development finance institutions like African Guarantee Fund. So you have a key partnership with AGF, where they're providing guarantees, protecting 70% of the loan portfolio of the bank, meaning if the farmer is not able to repay, then AGF steps in and repays up to 70% of the portfolio. This really helps the banks to ask for unsecured financing, which again, is facilitating farmers to accessing those loans, because if you ask on top of the collateral, this is usually a big deterrence, and it makes the loan officers more comfortable also to disburse the loans. And finally, with the third component that we are working on is embedding carbon credits within the green loans financing. Why? Because carbon credits is actually a fantastic opportunity for our farmers to accessing constant and additional revenues. So we're working currently with those tea, coffee farmers, macadamia and avocado farmers to kind of be able to leverage on satellite imagery so that we can show to the carbon credit buyers that trees have been planted and that the carbon is verified and certified. And we've seen that by doing that, we can actually improve the revenues of the farmers, almost double the revenues of the farmers every month. And this shows actually a constant cash flow that the banks can use to be able to lend. So there is a big opportunity a lot of government and public institutions have already worked on engaging the private sector and commercial banks into the green finance market, but we need to innovate and really work on collaborations and partnerships so that we can be able to deploy it efficiently. Back to you, Brian.
Thank you for these insights, Melanie. I think they really resonate well with what should be happening in the industry, particularly private and public partnerships, which is coming out very clearly in mobilizing green finance as well. I would just like to connect this to, just thinking broadly about that issue. And we know that smallholder farmers, some of them are located remotely, and that SMEs, some are not located within the urban centers. And just to you, Leo, your work in financial inclusion, how best can we engage microfinancial institutions in leveraging the flow of green commercial finance to reach the smallholders, even in the rural setup?
Yeah, thank you very much for that question, Brian. And I'll begin from where Melanie has left, and specifically, de-risking the market is extremely important in incentivizing the private sector, and in this case, specifically the microfinance institutions to come into play. Now, that enables these microfinance institutions to absorb not the full effect of the losses and the risks, and co-share it with various partners, particularly philanthropic development partners, etc. That is a component that is extremely important. Whichever way you structure the green financing tools, it is important always to have a component for de-risking, and that ensures that the microfinance institutions can be able to have pre-designed confidence to be in the process the long run. Secondly, it's important that we build the adaptive capacities of these microfinance institutions to be able to participate in the green finance and emerging areas of the same. And part of what can be done is ensuring that we have targeted technical assistance, and we also are able to provide other tools such as grants at the pre-stage and pre-designs, the early stages, to ensure that they're able to have the technical capacity to engage in these particular in the emerging markets and areas. But allow me to talk about a particular area that I think the microfinance institutions have not been given preeminence. Mostly it has been done for the commercial banks, and that is a participation in refinancing facilities. Melanie had spoken about their partnership with IGF, for example, they have. And it's important that we develop these particular refinance facilities, whether import substitution, whether export financing facilities, like the ones that have been deployed by the Reserve Bank of Fiji, or the Green Transformation Fund in Bangladesh, or the Disaster Reconstruction Credit Facility in Vanuatu, for example. So these refinancing facilities will be able to offer concessional financing to the microfinance institutions. Usually, access to capital for these particular institutions is usually very limited and very competitive in itself, and very costly. So concessionalizing these, more or less what I call socializing the laws for the microfinance institutions, is important in ensuring that we draw them in and they stay in the game in the short and long run. Brian, over to you.
Thank you. Thank you for these practical examples. Giving these insights and understanding the context of the continent, especially the role of agri-SMEs and the role of climate innovation and developing innovative finances. I'm just concerned about how well can we structure, particularly financing that is coming from multinational outside the country or outside Africa and flowing into Africa. And this is just to, as a follow-up question to Alfred, your work with CARE, for instance, mobilizing finance working across 8 countries. How well is this structured so that the green finance is flowing through the commercial banks, reaching microfinancial institutions, and ultimately, particularly on the element of agri-SMEs, having worked in the sector for some time. So what is the state of this, and how best can we deploy these strategies to mobilize more capital from the institutional investors?
Thanks, Brian. I'm joined in by a small green finance expert here. So yeah, so anyway, just giving a few examples from our work and what we've been able to do, and how well do you structure this financing to the to get to the farmers. So one, I think, just to borrow from what Leo and Melanie has mentioned, I think there is a role for us as development partners to play within the green financing structuring, and that number one is how do we provide de-risking mechanisms. So, for example, what we've done within our program in Somalia is, so we've been trying to support farmers to access drip irrigation innovations and how to do water efficient agriculture within Somaliland and Somalia itself. And one of the key things that we actually realize is that the initial cost of actually being able to access that product is very high. So what we did is that we got some money from the Danish Development Bank called IFU, and we took this down to Somaliland in partnership with a bank, the Dahab Shield Bank in Somaliland. And the idea was, how can we actually provide a de-risking fund that the bank in Somaliland, Dahab Shield Bank, is confident enough that the money that they're going to extend to farmers is going to actually be paid back. Yeah, so it's a form of a guarantee fund. But then to match that up, also we as CARE put in some money as a revolving fund, where if, for example, the cost of a drip is 100 shillings, then 30 shillings would come from the revolving fund, which they pay back with 0 interest. And then 40 shillings of the cost of the drip irrigation comes from the loan that the bank gives to the farmers, guaranteed by the Danish Development Bank. And then the farmers would actually chip in 30 shillings to the cost of the drip irrigation kit. Yeah. So what this means is farmers have contributed, of course, and have played a role. But also what this means is that the bank in Somaliland feels confident, and this is what Leo was talking about. So like a pre-designed sort of confidence that banks have now, in the form of how if I give this loan or extend this loan to a farmer, then I'm able to actually get back the loan, but also to be able to kind of cover the risks in a way. Yeah. In addition to that, what happens is that these banks are now able to, so for example, so we brought in this money and told the banks, farmers don't have money every other month. Yeah, because even if you have a drip kit, then it takes you 3 months to actually start harvesting. Yeah, so you can't give me a loan that I have to pay every month, yet I've not even gotten proceeds from the farming. Yeah, so we negotiated a way that their payment period or their payment plan is actually coinciding with their harvesting plan as well. So if you're planting tomatoes and you get your first harvest within 3 months, then the first payment will be within 3 months. Yeah. But then we went even a step further and actually talked to the bank and told them, look, because we're offering their financing at 12%, but then we've been able to give you a bit of leeway where we are providing some of the financing as well. So could you actually lower these interest rates? And that happened. They lowered that to 8%. Yeah. So what I'm trying to picture or to actually portray here is there's a space for everyone, if at all we actually come together and understand what our role is. And this is where green finance comes in, because every one of us is able to come into the structuring and provide some sort of de-risking mechanisms. Yeah. But even going a step further is trying to look at how can we use some of the pre-existing national and local kind of structures that farmers have to be able to make these financing accessible to them. And one of them is the cooperatives. Yeah. So for example, you go to a country like Ethiopia, where we are working as well, and you see the membership in terms of cooperatives is actually a mandate by the government. So government provides, like what Leo was talking about, like an enabling policy environment. Therefore, all farmers are required to be part of a cooperative. And therefore, extending financing through a cooperative becomes much easier and much more less riskier, because then a farmer will every day be able to take their produce to the cooperative. So you as a financier is actually more or less covered in terms of recovering back your money and recouping back the profits as well. Yeah. So that is one of the existing structures that we need to also really leverage on. Of course, not every country has this kind of structures, but important to look at those kind of things. Secondly is looking at working for care. One of the things that we are known to be champions of is the VSLA groups, the Village Saving Loans and Association groups, which are, everywhere across this world, name it. Of course, the level of how much money can be transacted within a VSLA group is not as high as what will be transacted within a bank. But still, you look at it from the perspective of how can we enable this kind of groups to also enable access to some of this financing to the members of those groups as well. And this has been done in a number of countries where, and this is heavily seen amongst women, and that is what we would call, even within a normal social setup, the chamas, for example, within the Kenyan context. It has been seen that they're able to actually address a bigger percentage of their access to financing through this kind of structures. And because also it is based on trust, based on knowing each other, it's a social kind of constituent that is actually designed within a social setup. Yeah. So how do we use also some of these existing structures to be able to leverage access to finance as well? Thanks for that.
Thank you, Alpha, for bringing it from a very global perspective, into the local context. I know our participants as well have questions that they would like to ask, and because they're also some of them are working in these areas around green finance or climate finance. So I'd just like to also give an opportunity to our participants to ask questions, and I'll hand over to my colleague Emma to ask some of the questions from participants.
Okay, we have the first question from Alois from India, and he asks, how does the Green Finance Fund interact with insurance companies to overcome these risks? Then a second question is from Isaiah. What are the opportunities available for insurance companies under Green Finance? I think we'll take all the questions. Then the final one is from Philip. What are some of the opportunities and challenges for scaling commodity-backed financing for agri-SMEs in Kenya?
Maybe perhaps Emma could provide some initial insights into that. One area of partnership that we see with the insurance company is particularly in enhancing market development. And both Alfsad and Melanie have spoken about it. Some of the product development insights that we have been used, including bundling of some of these green finance products and elements into the traditional products themselves, so that when we are able to sell, we're able to push these particular products out in the market, then we begin to have the green finance products and services also moving along. And I'll delve 1 minute into market development, because I think it's very important for the insurance company. When you have a mechanism that is able to address multiple risks and covers multiple risks at once in a single swoop, that is important, because usually when you address the risks separately and they're interconnected, especially within, for example, the slow set financial risks, climate change risks, or you have the adverse weather related risks, for example, it's extremely difficult. So often you look at having this kind of innovative product development where you're able to address multiple risks together. And I'll give you a specific example of what we have done, for example, at UNCDF with the parametric insurance product, and also the provision of disaster contingency mechanisms well ahead of the occurrence of disasters such as cyclones, etc. And these contingency mechanisms draw in actors such as the insurance companies, and also having products that are tested, whose demonstration effect is known, such as the parametric insurance, also helps to draw in partnership with the insurance firms, helps to draw in these particular partners. And finally, I would speak about the need to be able to go a step further to strengthen some of the target beneficiaries of these products, particularly the MSMEs and smallholder farmers, who then become the clients of the insurance companies. One particular incentive that drives them is the need to have profit, to realize profits. So if you strengthen the business case for them to engage in the green economy, and you then are able to provide risk coverage through the insurance companies, then those two factors often combine to increase the impact and increase the scaling and adoption of these these particular products. In essence, enabling these insurance firms to, for example, access new markets and access untapped markets, and ensuring that those particular markets are then the players are strengthened and the business cases are strengthened, so that they're able to adapt and deploy is important. So I'll stop it at that and give it over to my other panelists to contribute. Thank you.
Maybe just to say one or two things and to add on what Leo said, I think the role of insurance is very critical in actually being able to address some of the hindrances as to why farmers cannot access green finance. Yeah, and that comes in at a very critical point where we are saying, how can insurance actually be able to de-risk the level of engagement of farmers with access to finance? Yeah. So, for example, if I insure my farm, which is 10 acres of farm, I insure it against cyclones, against any climate change kind of effects. That should ideally be able to give financial institutions the courage and confidence to extend financing to me as a farmer. And that is the interplay between insurance and green financing, because then it comes in at a very strategic point whereby it's providing more confidence and designing confidence at play, where financial institutions are able to say, I am confident enough to give you financing as a farmer. So that is where I see the interplay between insurance and green financing. Thanks.
Thanks. Maybe to add on the last part, I think it's very important for insurance companies to also innovate and look at the bottom of the pyramid when they design those products. Yes, there is climate insurance that Afa has mentioned that is really key. But then you have to see it also from a bank point of view. Like, what are the key risks that a bank is looking at and that hinders them to disburse financing? For them at the moment, what we see a lot is related to the credit risk, and that's why a lot of banks are not coming in. Normally with green financing, you're supposed to also de-risk a lot of the business because you're putting in kind of climate adaptation, like infrastructure into the farm. So I would say, like, beyond just the climate related products, we also need loan related products, which includes like the normal life insurance of the farmer, the normal kind of like payback of the loans insurance, and the classic also like asset financing insurance, which still have a very low penetration in the farming industry. And one is because we are not managing to distribute insurance products efficiently and in a way that is adapted to very small farmers in rural area. So we need more micro insurance and insurance that is affordable enough for the farmers to be able to uptake this insurance so that they can be able to access the green financing. And yeah, I think that for us, what we saw is that a lot of training, education, and awareness is necessary when it comes to selling insurance, because like it's not something that is in the market really widely used, and it's not something that the farmers would go towards at first glance. So I think that bundling products, so again, partnerships with banks, partnerships with cooperatives, chamas, like kind of like would help to kind of redistribute this insurance and just adapt it to the local context. Back to you, Emma.
Sorry, Brian, there's a question that I see has not been addressed, and I know we are running out of time. And there's a question from Philip that talk about commodity-backed financing for agri-SMEs, and I'm not sure whether I fully understand, but please correct me, Philip. This is what I would call commodity financing in a way that it's based on commodity trading, ideally. And this we have tried in a number of countries where you have an off-taker, which is a company or an agri-SME coming into play, where farmers are able to produce, and then the off-taker or the person or the company trading the commodity kind of one becomes a guarantee for the farmers to access financing, but also are able to access financing themselves. So a bit of the challenges for this is, one, commodity trading is affected heavily by offshore kind of currency. The fluctuations in terms of the foreign currency is very heavy when it comes to commodity trading. So that needs to be addressed in a way that, and the way to address that is, one, how can you negotiate for credit as a company that is kind of looking at addressing those kind of fluctuations. Yeah. So more of getting money, getting credit on foreign bills rather than actually getting credit on local bills. Yeah. Number one. Number two is, when you're doing commodity trading and you're coming into play in terms of supporting farmers, is that one of the things that comes into play is how sure is the company that the farmers will supply to the company. Yeah, because farmers are also fond of side selling when they don't see the price is better, or when they see the price is better outside than what is being offered by the commodity buyer, then they most of the time actually go out and start side selling. So that needs to be addressed in a way that either you do a bit more of binding kind of contract farming, which also has its own kind of challenges, but also how do you give farmers a price that is more or less able to match the market price? Yeah, how do you negotiate your prices with the farmers? Lastly, for me, I think when it comes to commodity trading, one of the things you can sell, or you can actually be able to tap into the green financing, is being able to clearly articulate your value add in terms of, one, environmental kind of impact, and two, social impact. Then you're able to actually access green financing much more easily, because then you are actually looking at the entire value chain all the way from production to markets. You're actually addressing most of the needs that are at play all the way from production, where farmers are engaged, to the market, which is the end of the value chain. So there is a lot of opportunities in terms of financing for commodity-backed financing, but then you have to clearly articulate what your value add is as well, and then you're able to actually access that money. Thanks, Brian, and over to you.
Thank you. I know we are running out of time, but just to close with this wonderful discussion, I'd just like from the panelists to give a summation or the key takeaways that we have from COP29, which recently ended. Just briefly, what is the stake of green finance in the years to come, especially what is emerging from COP29, that we will be able to close from there. We'll start with you, Melanie.
Yeah, the key takeaways for me from this last COP is that clearly for the African continent and the developing countries, we have to find ways to align the incentives, or like to align basically the interests of the private sector according to our own climate finance, because we are really failing in basically getting any agreements that could fit the bill what we have to finance to basically meet climate adaptation and carbon removal targets. So in my opinion, we need to kind of like find a way to innovate locally for local problems and ensuring that we can include the entire value chain of financial institutions from the DFIs to the banks all the way to the microfinance, fintechs, and the ones on the ground. So we have all those high level discussions, but they're not yielding the results that we're expecting. So it's also time for us to ensure that we can put ourselves in the table and align the incentives. Leo talked a lot about our own regulations. We're missing local carbon markets and local regulations when it comes to green bonds. It is time for the African continent to make sure that we take that into our own hands.
Yeah, thank you, Melanie. Perhaps, Brian, I'll talk about these three key areas of tech insights that I've noticed in our discussion today. And the first one is the obvious one, but also I think one of the most important, ensuring the enabling policy and regulation. And more or less, I would characterize it as ensuring that there is a safe, responsible, and profitable space for the private sector to participate in, and that regulators play an important role in hedging this space to ensure that it grows and to ensure that it scales up, even as the problem of the climate change challenges grow, and as the financing gaps continue to grow, as we have seen from COP 29 that we have just the other day. Secondly, I see the need to be able to develop the green economy market further, because if we are to ensure that green financing becomes lucrative for the private sector, that particular market segment has to be developed. And we need to have enough incentives and also enough capital and interventions to develop that market, not just from the supply side, but also from the demand side. And finally, I think because of the growing financing gaps, it's important for us to move beyond just incentivizing for mobilizing flow of capital from the private sector to catalyzing the flow of that capital into the green finance ecosystem, ensuring that for every dollar that we provide into the system, it's able to catalyze a several X factor of private sector investment into the space, and figuring out how we do that and how we move from mobilizing the capital to catalyzing the flow of that capital is something that I think will be important. Innovation, of course, is an area that comes to mind, but there's much more that can be done. Brian.
Thanks, Brian, for the invite once more, and maybe just to wrap it up in very few insights. One is it's interesting to see the role the private sector continues to play now moving forward in terms of providing access to financing, and as a private sector kind of champion, I'm very much happy to actually see more of private sector now coming into play into this sector. Of course, the questions of how they play into the sector and need to be addressed, and we need to figure that out. But I think we are one step ahead in terms of now private sector being engaged and actually seeing the need to actually be engaged in the sector. So that's quite interesting, and that's a step ahead. Yeah. Number two, I think we need to really localize our interventions when it comes to climate financing and green financing. I think we need to really contextualize every kind of situation. I think it's not a one kind of fit for all. Every country, every context is very different. So we really need to invest a bit more in understanding the local context. I was very surprised the other day that Islamic law, Islamic banking and normal banking are actually very different. Yeah, quite a whole kind of different worlds. So, and that then comes into play when you're actually designing some of these instruments. So localizing the interventions is very important. And lastly, for me, I think it's smallholder farmers actually know what to do most of the times. Yeah, they have the knowledge, they have the know-how, they have all the knowledge that they need. Yeah, so we need to also stop assuming that we are bringing new things to them, because really most of the time they understand some of these things. So it's just a matter of trying to understand how do we partner and how do we work together to actually address some of these challenges, but they actually know how to actually address some of these things. Lastly for me is COP29 has, I think the question of whether it has delivered or not is based on where you come from. In terms of financing, the 3 billion is both private and public financing, which I think a lot of CSOs would say is wrong, because then the 3 billion should actually come from public financing. Yeah, that's the argument. But I think from where I sit, I think it is interesting to see, and once again, going back to my point, that private financing is coming into play. The question is, how do we structure that? And the question is, how do we actually tap into that in the best way possible? Thank you so much.
Thank you. To close, the key takeaway for this session or for this webinar is that we need to enable, mobilize, and catalyze climate finance with all stakeholders, particularly microfinancial institutions and financial institutions engaged in developing effective financial products that can actually work for agri-SMEs and SMEs. Thank you very much, our panelists, for sharing your insights and for dedicating your time to speak on this topic, yet very challenging. And thank you very much, everyone, for attending and for listening carefully to this. Until next time, have a good evening.